Picture a stock that climbed more than 40% in a single year, but somehow barely flinched while doing it. That's the strange puzzle sitting inside H World Group's numbers right now, and it's exactly what we're digging into today. Here's the kicker. This company just reported earnings yesterday on Monday, August 17th, 2026, before the market even opened. So everything you're about to hear is about as fresh as it gets. Let's start with the big picture. H World Group currently carries a market cap, the total value of all its shares combined, of $14.33 billion. But there's a second number that tells a fuller story. Enterprise value, which adjusts market cap for debt and cash, sits noticeably higher at $17.08 billion. Why the gap? Because debt is playing a bigger role in this company's story than the market cap alone lets on. Keep that in mind, because we'll come back to it. On valuation, the stock trades at a trailing price to earnings ratio, or PE ratio, of 20.21, meaning investors are paying about $20 for every $1 of past annual profit. The forward PE drops to 15.97, hinting the market expects earnings to grow, and its PEG ratio, which weighs that PE against expected growth, sits at 0.99, close to 1, a level many investors treat as reasonably priced relative to growth. But here's where things get interesting. Over the past 12 months, this company brought in $3.92 billion in revenue and converted that into $741.37 million in net income, a profit margin of 18.93%. Gross margin was 41%, and EBITDA margin, a measure of core operating profit before interest, taxes, depreciation, and amortization, came in at 33.41%. Solid numbers on the surface. And that's not even the most surprising part. Return on equity, which measures how efficiently a company turns shareholder money into profit, sits at a striking 38.13%. At first glance, that sounds impressive, but return on assets, which measures profit against everything the company owns, is only 7.45%. That's a massive gap, and when return on equity runs that far ahead of return on assets, it's usually a sign that debt, not just raw business performance, is doing a lot of the heavy lifting, which brings us straight to the balance sheet, and this is where investors often get confused. H World Group holds $2.29 billion in cash, but carries $5.04 billion in total debt. That leaves a net cash position of negative $2.75 billion, or negative $8.94 per share. In plain English, the company owes more than it has in the bank. That might sound alarming, but here's the twist. Its interest coverage ratio, which shows how easily operating profit can cover interest payments, sits at 24.62, an extremely comfortable cushion. Even with all that debt, paying the interest bill isn't a struggle. Despite carrying more debt than cash, the company still produced $1.19 billion in free cash flow over the past year, the cash left over after operating costs and capital spending. That works out to $3.88 per share, giving the stock a free cash flow yield of 8.31%, a healthy amount of real cash generation relative to its price. Now let's talk about the dividend, because this is where the story flips again. H World Group pays $2.11 per share annually for a dividend yield of 4.53%, a fairly generous payout. Dividend growth over the past year came in at 32.69%, which sounds fantastic. However, one number changes the entire picture. The payout ratio sits at 89.73%. That means almost 90 cents of every dollar earned is handed straight back to shareholders, leaving very little room for error if profits ever soften. On top of that, buyback yield is actually negative 0.37%, meaning the share count is quietly growing instead of shrinking, the opposite of what a buyback program would do. So how has the stock behaved on the charts? Over the past 52 weeks, the share price climbed 40.94%. Yet its beta, a measure of how much a stock swings compared to the overall market, is just 0.11, remarkably low for a stock that moved this much. But here's a detail that's easy to miss. The 50-day moving average sits at $42.44, while the longer-term 200-day moving average is higher at $47.26. When the shorter-term average sits below the longer-term one, it often suggests the stock has cooled off recently, even after such a strong year. Meanwhile, the Relative Strength Index, a momentum gauge, sits at 67.23, creeping toward levels some traders consider overbought. Ownership adds another layer. Insiders hold 32.39% of the company, while institutions hold 65.95%, showing heavy professional attention on this stock. Short interest. The percentage of shares betting against the company sits at 4.75%, with a short ratio of 7.23 days to cover. Not extreme, but not negligible either. And what do the professionals think? 18 analysts currently cover H World Group, and their consensus rating is strong buy, with an average price target of $59.51, implying upside of 27.68% from current levels. Their forecasts call for revenue growth of 6.05% and earnings growth of 13.75% over the next 3 years. Add in a Piotrowski F-score of 7, a financial health score that typically runs from 0 to 9, and the fundamentals look generally solid. Two very different stories, both true, both hiding inside the very same set of numbers. So here's the real question worth sitting with. As H World Group moves forward from here, will its efficiency and cash generation keep outweighing the risks on its balance sheet? Or is that 90% payout ratio a warning sign that's easy to overlook today but hard to ignore tomorrow?